kind of provides all the different rates that apply to the different types of payment. Okay. Okay. Now let me run through very quickly on compliance requirements. Okay. Now when there is withholding tax, the question is always as to when should I account for it. Okay. So you have to account for it at the earliest of 3 events. The first event is when the payment is due and payable based on a contract. So if the contract basically says, okay, the payment is due and payable today, then your obligation to withhold tax arises today, although you may not have physically paid the payment. Okay? So physical payment is not relevant from that perspective. Is what does the contract say? Okay? If there's no contract, then you look at the invoice date. Okay? So if you receive an invoice today, and this payment is to a non-resident, which falls within the withholding tax net, then your obligation arises today, although you may physically pay a few months down the road. Okay? The second is when you make a payment or you credit to an account of the non-resident. Okay? So if you may not have received the invoice, but you're making a payment upfront, then at that point, the obligation arises. Okay? The third is the date of actual payment. Okay? So therefore, when you look at, it's the earliest of any of these, okay, even in situations where sometimes you might contra accounts, you need to make a payment to a non-resident, but the non-resident also owes you money, and then you say, okay, let's contra the two. The non-resident may not have issued you an invoice yet, but because you contra, that falls under item 2, and therefore there's a withholding tax obligation at that point in time. Okay. If you look at director's fees, for example, the only difference is that in director's fees, when you look at item 1, there is no contract that might specify when payment is due. Okay, the non-resident director will not give you an invoice. So from that perspective, we look at when was it approved in an AGM. Okay, so if the payment is approved in an AGM today, then today is the day that you are liable to withhold tax. Okay, but if you make the payment earlier than it was approved in the AGM, then you take the earlier date when you make the actual payment and withhold tax based on that. Okay. And timing of payment. Okay. Withholding tax has to be paid to Inland Revenue. Okay. By the 15th of the following month. So, if the obligation is to withhold tax today, then you have to make the payment by the 15th of March. Okay. So that is the deadline. There are concessions for multiple payments. It applies to certain payments, like payments to non-resident professionals, where you can lump multiple payments into one filing, okay, but it does not apply to all types of payments. Okay, in this slide, I just mentioned about all the different forms that are required to be filed. Okay, it depends on the type of payment. Okay. The most common would be IR37, which is the one that that governs interest, management fees, and so on. It's a common one. Okay, the rest 3A, B, C, and D are less common. Okay. Okay. Now a couple of other deadlines to take note of is that sometimes when you have when you make use of a tax treaty, for example, to reduce the rate of withholding tax, what Inland Revenue would require is a certificate of residence, okay, to kind of certify that the non-resident that you are making a payment to is in fact a resident of the other country, and the treaty is between Singapore and the other country, right? So that certificate of residence must be furnished by 31st March of the following year. So if you are filing now and you are claiming a reduced rate of withholding tax under the treaty, then a certificate of residence must be furnished by 31st of next year, and failing which, Inland Revenue would go back and assess on the normal rates as though that the reduced rates do not apply. Okay. Let's come to penalties. Now, if there is late payment of withholding tax, that means you have failed to withhold, okay, the penalty will be 5% of the tax that was not withheld, okay. So that's the first penalty. Then for every 1 month that you fail to withhold, okay, that's 1% added on, okay. But the maximum of additional penalty will be 15%, okay. So you put the 5%, which is the initial penalty, and then the additional 15%, which is the maximum. The total penalty is 20%, okay. And that's the maximum penalty that they can impose. So in a way, it's good news, you know, because if you have not withheld for the last 4 or 5 years, you know that the maximum exposure is only 20%, okay, not more than that, okay. Now, the important thing to note here is that this penalty applies when you fail to withhold tax, okay. Now, what happens if you withheld but you did not pay? Okay, you withheld but you did not pay to IRAS. Then it's a stiffer penalty. Okay, the penalty can be equal to 3 times of the tax withheld, or a maximum fine of 10,000, or to imprisonment up to 3 years, or a fine and imprisonment. Okay, because this is a more serious offense of, you know, holding the money which belongs to the government and not paying. Okay, so there's imprisonment and so on. Okay. When I was talking about this once, you know, the financial controller asked me this question: who goes to jail? Okay. I guess whoever is responsible, you know, who knowingly withheld and did not make that payment, you know. So whoever is guilty of that offense, then of course, you know, can be charged. Okay. Okay. Moving on, you know, application of tax treaties. Okay. Now, tax treaties play a very important role in withholding tax, because although, you know, the 14 types of payments attract withholding tax under the domestic law, the treaty can either reduce the rate or it can exempt that income from withholding tax altogether. Okay. So application of tax treaties, you know, can result in a lot of savings to the company if the company is the one that's bearing the withholding tax. Okay. You know, if the company is not bearing the withholding tax, okay, you know, there may not be real incentive for you to go and apply a treaty, because at the end of the day, it's a tax suffered by the non-resident, right? Okay. But, you know, from your perspective, if you're bearing the withholding tax, you know, you might want to look at treaties, you know, because the real savings to you. Okay. Now, looking at tax treaties, you know, all the various objectives, and, you know, if I were to summarize, you know, what really is a tax treaty? Tax treaty is about 2 governments coming together and sitting on the table and deciding, okay, how do we share taxes? That's what tax treaty is all about. Okay, because sometimes you can be taxed in Singapore, you do some transactions in another country, you might be taxed there as well. So you're taxed in 2 countries. So these 2 countries come and say, okay, you know, let's enter into agreement. How do we share taxes arising from this particular company, particular individual? Okay, so that this individual is not taxed twice. Okay, why do countries want to do that? Mainly because to promote global trade. Okay, because if everybody is going to be taxed twice, 3 times, 4 times around the world, nobody is going to actually do any transactions outside their own country. Okay, so it'll be a big obstacle to global trade. So therefore, countries come together and say, okay, how do we share taxes? Okay, and they do it in many ways. Okay, the first way could be, okay, you pay some tax in my country, some tax in the other country. Or it could be by saying, okay, tax is only paid in one country and the other country exempts it from tax. Okay, so there are many ways of doing it. Okay, so we'll skip this. Okay. Now, the most important thing about tax treaty is that the tax treaty always provides a favorable situation. That means if the tax treaty provides for a reduced rate, then I can apply the reduced rate. Okay, but in sometimes the treaty rate can be higher than the domestic rate. For example, under our domestic law, there's no withholding tax on dividends. Okay, but under the treaty, it might say, you know, dividends are subject to withholding tax at 15%. Okay, but in that situation, I apply domestic law, because domestic law is better than the treaty. Okay, So therefore, the treaty cannot impose a tax. The treaty can only relieve a tax. Okay? So we always use treaty to our benefit. If it doesn't benefit us, we don't have to use it. Okay? So that's the point that I want to make. Okay? Looking at treaties, this slide, I think the point that I want to make is that sometimes it's good to understand what is the model that a particular treaty follows. There are three models actually. There's OECD model, Organization of Economic Cooperation and Development, those European countries largely. Okay? Then you have the United Nations model. And then the third model is the US model. Okay? Because the US doesn't like to follow anybody else. Okay? So if you want to enter into a treaty with the US, you have to follow their model. Okay? So like Singapore, our treaties with a lot of European countries follow the OECD model. A lot of the treaties with Asian countries follow the UN model. Okay? The difference is that OECD model is fashioned to benefit developed countries. UN model is fashioned to benefit developing countries. And why sometimes we need to understand which model, because both the OECD as well as the United Nations do give interpretation. Okay? If you go to their website, OECD website or UN website, they have interpretations of the OECD model. And sometimes, when we are applying treaties, we want to know, okay, what is the meaning of a particular word? How do I interpret certain things? Then when I know which model is after, I can actually go to the OECD model or UN model. They have given a lot of information on how to interpret, and that kind of helps us. Okay? So that's the point that I want to make here. Now, in terms of the scheme of treaty provisions, if you look at how our treaty is structured, there are certain types of income that are only taxed in the source state. Okay, so the income arises in Singapore. The source is here. It's only taxed here. Okay. Then there are certain types of income which is source here, but Singapore gives an exemption under that treaty. Okay. And the third is, is taxed in both the countries, but the source country reduces the rate of taxation. Okay, provides for a reduced rate. Okay. So I've kind of, in a few slides, when you download and you're looking at these slides, they are basically three, I've kind of grouped them into three. So these are the types of income which are generally taxable at source, that means taxable in Singapore. Okay. So for example, if you look at directors' remuneration, okay. So if there's withholding tax on directors' fees, for example, it's always taxable in source, that means in Singapore. A treaty will never exempt that from tax. Okay. Then there are certain types which are exempted from tax, like shipping income. Some treaties provide for full exemption, some provide for partial exemption from tax. Okay. Then we have types of income which are reduced at source. That means Singapore is given a right to tax these, dividends, interest, royalties, or technical service fees, but under the treaty, the rate is reduced. Okay. So technical fees under domestic law is 17%, but under the treaty it might be 5%. Okay. Royalty, domestic law is 10%, some treaties is 8% or 5%. Okay, so a reduced rate is applied. Okay, so I've kind of run through like a train, okay, looking at all the basic concepts, of withholding tax, just to give you an appreciation of what are the things that we need to really look at. Okay, now this is the fun part, looking at planning issues for withholding tax. Okay, which I'm going to actually cover after the break. Okay, so I think I'm going to pass over to Sandy from CCH, and she's going to give an introduction to the product, I think. Yeah, all right. See you all later. Thanks. Okay. Now, if you recall, this morning I was, talking about 9 key questions. Okay. Now, these 9 key questions, form the basic block. From here, we can, develop further. Okay. 9 questions can become 18 questions as we drill down. So when we look at it from a planning perspective, okay, each of these questions here offers a particular angle to look at withholding tax from. So when I look at the second question, does the payment fall within the provisions of section 45, 45A to 45H? What essentially we are looking at is characterization of the income. Okay, because as we know, there are 14 types of payments which are mentioned in section 45, and as long as the type of payment that you are making to the non-resident falls within that, then that's withholding tax. And a lot of times, it has to do with how do you characterize a particular income. So if you're making a payment, you can call it royalty, but in actual fact, is it really royalty? Such that you apply the 10% rate, or is a character something else for which a higher rate might apply? So a lot of times it's not so much of the terminology that we use, but rather what is really the nature of that particular payment. Okay? So from that perspective, there is, from a compliance perspective, we need to ensure that the character of the income conforms to section 45. So that's from a compliance perspective. But from a planning perspective, it also opens up opportunities to characterize a particular income to then ensure that you might apply a lower withholding tax rate, for example. Okay? And when we look at establishing the withholding tax rate, when we look at application of tax treaties, okay, again, there are planning opportunities in terms of determining, can I use the tax treaty to exempt a particular income from withholding tax, or can I apply a reduced rate? But then again, in some situations, I might not need to resort to using the treaty because the domestic provision may actually be better. And it might not be so obvious because we need to make some calculations to do the comparison. Okay? So again, there are opportunities for planning from that perspective. Sometimes the domestic legislation gives an opportunity, for example, in terms of where a contract that you enter into has one lump sum payment for all kinds of things. For example, for services rendered in Singapore, for outside Singapore, for rental of equipment, for royalties, all lumped into one agreement where you make one lump sum payment. Okay, so in such situations, there could be some part of the payment which is exempted from tax, but since you can't kind of extract that out, Inland Revenue will just conveniently say, apply the highest rate to the entire amount. Okay, so therefore, from a planning perspective, is how can we structure contracts? Okay, so if multiple payments are made, can we split the contracts to make it clearer that some are exempted, that some are actually with a reduced rate, and some at a normal rate? Okay, so these are some of the opportunities, and if I were to select some of the issues to discuss, first I want to talk about characterization. Okay, how characterization is important and how that affects compliance as well as planning. So time permitting, we'll try to go through a few examples, okay, which I've listed there. We'll look at royalty versus rental, royalty versus technical fees, employee versus a non-resident independent professional, and then we look at director's fees as well. Okay. Then the second point there, tax treaty versus domestic law. I would like to go through an example to highlight why in some cases, you need to do kind of comparison, do some computation to determine whether should I use the treaty or should I use the domestic law. Okay. And that also applies to structuring of contracts. So I'll use one example to kind of go through that. I'm not sure whether we'll have time to talk about PE, okay, because it's kind of a lengthy subject, but if we have, then I'll try to just mention briefly as to how understanding PE can also help in terms of withholding tax planning. Okay. So moving on, let's look at royalty versus rental. Okay. Now the characterization is important because of the fact that there are different rates. Because the same rate applies, sometimes then you can say characterization isn't important. If both are at 15%, then it doesn't matter, right, whether you call it royalty or rental. Okay. But because there are different rates, it becomes important, okay, as to you ensuring that you're applying the correct rate. Okay, so that's the first point. Okay. Secondly, from a planning perspective, if you are actually bearing the withholding tax, if you call it royalty, it's definitely better for the company because you bear a lower withholding tax rate. Okay, so planning perspective becomes important as well. Then there are certain concessions which apply. You know, IRS has given some concessions, and concessions given to royalties and to rental are different. Okay, so for example, if you look at rental, you know, Inland Revenue has said, okay, if you rent cars or laptops or mobile phones overseas in respect of a business trip overseas, okay, then you don't have to withhold tax when you make payment to a non-resident, okay. But such concession will not apply to royalties, okay. So and similarly for royalties, there are certain concessions, okay, like when you buy software, okay, or you download software, there are concessions, but that does not apply to rentals. So because of this difference, characterization becomes very important. So then the question is, what is royalty? Okay. Again, as I mentioned earlier this morning, you know, there are not awfully lot of definitions in Income Tax Act. Okay, royalty is not defined, okay. And therefore we need to look at what is the common understanding, okay, of royalty. There are several possible definitions. One is for the use or the right to use any copyright of literary, artistic, or scientific work. Okay. Now, interestingly, you know, when you look at copyright of literary work, okay, you know, when we make payment for software, we're always asking ourselves, you know, am I making a payment for that particular disk, okay, which is really a product, or am I making a payment for an intangible that's contained in that software? And therefore, is it really a royalty or is it a product? Okay, and this question, you know, was raised many years ago. You know, when the legislation was implemented with regards to withholding tax and looking at software payments, and a lot has to deal with the copyright law. So if you look at our Singapore copyright law, okay, program, that means when somebody writes a program that's in a software, that is defined as copyright of literary work. Okay, so therefore, it falls within the definition of royalty. Okay, so therefore it becomes important, you know, when we look at some of these things that we are paying for, whether does it fall within that definition. Okay, then of course the other types of payments which are more common, you know, you look at like payment for trademarks, for patents, for secret formulas, and so on. Okay, these are all royalties. Okay, including payment for sometimes what do you call a secret process. You know, so if your company is, you know, manufacturing a very special kind of, say, a chicken essence, for example, and you are getting a secret recipe from a non-resident, and you're making a payment for that, so that is a royalty. Okay, because the right to use information or process. Okay. Now there is a definition under our Economic Expansion Incentive Act. The EEIA is basically an act that governs all the different types of tax incentives that are given by the government. Okay. There is an incentive that governs royalties over there, so therefore they define what is a royalty. And it's kind of interesting, you know, if you look at the definition there, they say any royalties, rentals, or other amounts paid as consideration for the use or right to use copyright, scientific works, and so on. So again, they use the word rental. Okay, so it's a royalty or rental, but the question is, what is it for? So here the definition is more towards an intangible property. Okay, so if a rental is paid for an intangible property, chances are that might be considered as a royalty and not as a rental. Okay, and therefore, you know, if I were to kind of summarize, you know, what are the possible arguments when we look at royalty versus rental. Firstly, a royalty normally tends to be paid to commence production. So for example, you know, if you are going to manufacture t-shirts and you need to put a logo, okay, like a Disney character, for example, okay, firstly you need to actually pay a royalty in order to do that, and it might be depending on, you know, are you going to print 1,000 T-shirts or you know, 1,000,000 T-shirts, and the payment might vary. So it's something that's paid in order for you to commence production. Okay, whereas rental is to keep the productive equipment in use. So if you stop paying rental, then you can't use the equipment to produce.